Hello, in this video I'll be explaining moving averages and how to read them and understand them. So if you go to indicators here, you'll type in moving average, and here we see there's a whole bunch of different moving averages. This normal moving average and the exponential moving average. We'll go with the exponential moving average because in simple terms it has more power on the future trend than it does the past. So a moving average, all it does, it just takes the previous, it takes the history of the price and plots it on a line. So the 9 moving average would be the average of the last 9 candles. On the monthly chart, it's the last 9 months. If we go to the 4 hours, is the last 4 hours. If we go to the hour, it's the last 9 hours. If we go to the day, it's the last 9 days, in that sense. So we could go here and adjust the inputs here and make the length, say 50. So this is the last 50 candles with more emphasis on the future than the past. Basically, like the last 50, the most previous 25, say, have more influence on future trend, basically exponentially showing you how the line can move. So the moving average is just a general idea. It's just a trend. Anyone can draw one. You could basically just eyeball a moving average and get the general sense of it. But it's good to use multiple moving averages. You don't want to go crazy. But one most traders like to use is the 50 and the 200 for macro reasons. When you see the 50 crosses below or above the 200, that is a signal of a reversal in trends. So here we see recently, back in January 2022, the 50 crossed below, and this indicated downward movement. So the trend crossed downward and we headed downward. That is completely different from May of 20, when the 50, it quickly dipped below, but once it dipped up, it stayed above the 200 for a solid 2 years. And this is how moving averages work. Lots of people like to use, for moving averages, you can use Fibonacci numbers. Say like 34 and 55. They also give you good ideas of trends. We'll get to Fibonacci later, but whatever history numbers you would like to use, lots of people like to use, say, 60 and 80 or 60 and 90. So you get a good idea of the previous 60 and the previous 90 is another good uh, way to get an idea of the trend. Here we see a squeeze, a potential crossover, potential bullish. If the 60 crosses above the 90, that could be a bullish indicator. But you never want to use just one indicator without any other knowledge, without any other analysis. You want to factor in a whole bunch of these things at once. If you just take one, it's a good idea of one, but it doesn't give you the whole picture, and you can be really wrong just basing your whole trading scope and ideas off of one indicator. So thanks for watching.